most popular idea, I would say, for beginners in options being like, oh, go sell a put spread or sell a call spread or buy a call spread, buy a put spread, whatever, and do it so that you risk $50 to make $50. A very easy concept for a lot of people to get on board with. Oh, I know Apple stock. Oh, I kind of understand what calls and puts are. I can go in there and buy a $1 wide call spread right at the money and pay 50 cents for it times $150 and have the ability to make 50 cents on it times $150. And that's really straightforward. If the stock goes up and I bought that call spread, I made $50. If it goes down, I lost my $50. Inverse relationship for if I bought a put spread. And then the short options, we're going wild with all the permutations. Futures, actually a simpler derivatives product. The idea would be, instead of buying an at the money call spread and wanting it to go up, I would just buy the future and want it to go up. Same with, instead of buying a put spread and wanting it to go down, I would just sell the future and want it to go down. The problem becomes for a lot of people, especially when you talk about E-mini S&P futures, traditional crude oil WTI futures, traditional gold futures, on a day like today, especially a week like this week in crude oil, a day like today in gold, we're talking thousands of dollars in a matter of minutes. That's a lot for people, especially when you don't have the ability to say, oh, I'm going to buy this call and then I'm going to sell a call against it and thus define my risk there. Or, oh, I'm going to sell a call and I'm going to buy a call against it, define my risk there. I can't, get into the thousands of dollars. Or another thing that really scares people off, the infinity symbol. Whenever that pops up on your potential loss, that is, we're human, right? Like, that is going to affect my taking advantage of opportunity in the market. And something that I've really been trying to instill with people, especially small exchange products. I mean, we've got products as small as $200 and you only have to put up about $50 to trade it. I mean, that in itself is truly innovative. You'd be hard pressed to find any futures product that is as small as a couple $1,000, let alone $200. And so, really trying to instill this idea of like, yes, it's futures, and yes, it's leveraged, which means you have to pay less to put to get that exposure, which is great, but also scares people off when those products are hundreds of thousands of dollars. With these new products from the small exchange and with some of these strategies that we really work to educate our users on, you can work that risk down lower and at the end of the day define that risk with certain order types and stop losses and everything else at a very manageable level, whereby with traditional futures, even if you did use, anybody who's traded E-mini S&Ps knows, if you put a stop order in for a $50 loss, you're going to get dinged within microseconds there, much more attainable with some of our futures from the small exchange. Now, the backdrop for today's conversation on defining risk in futures is crude oil, a market that's dropped more than $2 two times out of the last 5 days. Very rare moves seen here in crude. And this is one where the flashbacks start rolling in, right? Where it's like, man, just last year at the height of COVID and shutdown and all these different things, and airlines not needing any jet fuel from crude oil, people not driving around, not moving around, not needing gasoline from crude oil. This market got down to, in spot value, $20, $10. Some of those futures contracts went negative, freaking people out. And so you see these $2 sell-offs, and the active trader, the person who knows the numbers and knows that this is outlier territory, wants to jump in and trade that bounce. But when that market's in free fall and it's only at $70 a barrel and you know what it's capable of, that's when you start to maybe hesitate. You miss that opportunity, or you don't even try to take on that opportunity because of what could happen. And this is something where options are great because you could see that huge down move and you could sell a put spread in there and be like, oh, okay, like worst case scenario, if I sell the 65 put and I buy the 60 put, then I'm just out a couple $100 with the small crude oil futures options, which are coming very soon. And that's it. Worst case scenario, that's all that happens. But day traders, people who are looking for shorter term, quicker, more reflexive opportunities, like myself included, don't want to have to, you know, go to the put that's slower moving and then define the risk on that put, make it even slower moving, also sacrifice some of the money that I could make to the upside and how quick that money could roll in if we see a bounce that takes, I mean, I want to be trading these big $2, $3 moves in crude and get my, profits in a couple of minutes. I don't want to have to wait weeks. And, next week or 2 weeks from now, crude oil is trading wherever. And all you wanted to do was take advantage of the big sell-off on, August 2nd, or the other big one, I believe, on August 4th. And you've got a trade that's taking, weeks, potentially months, because you didn't want to jump on the futures. So let's talk about what we can do to, mitigate some of that risk and then end up defining it and feel better about trading some of these markets like crude oil or like today, gold coming out of nowhere with some big moves. Standard deviations are huge, huge for futures traders. If you're into options and everything else, it's similar to the implied volatility. The standard deviation is essential for futures. Now, what does it do? It's very simple calculation, similar to implied volatility. Maybe not very simple, but relatively simple calculation that lets you know, okay, if puts and calls are trading for X, then the implied volatility is Y. Oh, puts and calls are now trading for A. Well, now the implied volatility is B, and it adjusts with that. This is the same with the standard deviation and futures prices and that derivative. Oh, futures prices are moving around a ton. Well, then our standard deviation is going to be pretty wide. Oh, futures aren't moving around so much. Oh, our standard deviation is going to be very small. Actually, standard deviations worked into that calculation of implied volatility. And you can kind of catch my drift here if you know about options. Oh, the underlying market's moving around a bunch. Implied volatility is likely going to be high because now option prices are more expensive. Oh, that market's not moving around at all. It's dead. Implied volatility is going to be very low because the cost of options is lower. All these things, options, futures, standard deviation, implied volatility, very synergetic. And we use this standard deviation to gauge where we might enter. And this is Pete and I and other futures traders will kind of quickly say this in passing, like, oh, the average day in this market is 70 cents, or the average day in crude oil recently about $1.25. And so I'm looking at opportunities when, like I said several times this week, the market's down more than $1.25. That's where we tend to see the real back and forth, the opportunity for day trades in there, or up $1.25. And this is the same calculation, different numbers for every market. Stocks have a standard deviation, metals have a standard deviation, interest rates, and we use this same metric, similar to implied volatility, to level that playing field and be able to say, okay, the standard deviation in interest rates about 30, 40 cents, markets up or down 20 cents. I don't have anything there. Standard deviation in crude oil about $1.25. That market's down $2. That I need to go jump on. But what I want to talk about more today is using this to know where to define that risk, because it's great to know, okay, $1.25, that is a good metric. But what do we do when that crude oil market moves down $1.25? Maybe I buy it down $1.50 and then it's down $2.50. Do I just hold on to that and pray that it comes back? No, that's not how we tend to do things here, because these are all standard deviations based on daily net changes. So what happens when market moves down $1.50? I buy that market down $1.50, goes down to $2, and it closes there. Well, the next day, everything resets. It could be down another 70 cents. That would even be an inside day. It could be down another $1.25, like we saw multiple times this week. So I want to jump on Monday and take a look at what we saw on Monday and where this stuff doesn't pan out for us sometimes. The market moved down $1.25, opened up around $73, got down to 72, 71 and a half in the middle of the day. That's where I would be getting in this crude oil market. What did it do from there? Well, it moved another 50 cents, 60, 70 cents lower, and then closed right around there. That is fine. That's where I'm taking a loss on a day like a Monday, defining that risk, and also defining that risk once I get into that position, if the market's down $1.50, I buy. I'm saying to myself, my risk is defined at 50 cents or 60 cents, whatever you want it to be. For me, it's usually with the small exchange products around 50 cents to a full dollar, given their universal construction. And that allows you to be able to get in on Tuesday, because this is the thing that we talk about all the time. If you don't define your risk in futures, then you've got the market down, $2.50, you're out 50 cents or a full dollar. And then you get into Tuesday and now the market's just down another $1.50, $2. And now my losses are really piling up. Not only are my losses piling up, but I haven't afforded myself the flexibility to now say I've got nothing on going into Tuesday. And that's the day when everything bounces back. So this is a situation where if you do define that risk as you enter futures with, stop orders or whatever fancy stuff your platform is allowing, yes, you're going to take losses sometimes, but the standard deviation is a 68% confident metric there, which is to say that 32% of the time, yeah, we'll see those losses. 68% of the time, we'll see days like Tuesday, or like we saw on Wednesday, market moved down $2, bounced back. We've seen plenty of bounces in crude oil this week, but if you bought on Monday, you didn't define that risk, then you're just holding on to some poor longs in small crude oil futures. So defining risk in futures is not as simple as yet. We'll see what we're able to come up with from the small exchange, but it's not as simple as options yet in a matter of, okay, I'm getting into this position with the risk defined. But you can define that risk in your mind and in your platform when you enter that position with different order types. Or if you are active and you're watching markets, you can say to yourself, I bought these 71.50s and I'm out at 71. And that is it. Defining risk essential for futures trading, especially when markets start moving and opportunity rises like we've seen in crude oil this week. So that's all I've got for you here today on small stakes. It's been a fun week here. A lot of people getting back to markets from summer vacation and everything else. And we've been seeing a great amount of movement. We hope it continues, and we hope all of you out there are enjoying the small exchange products, and those community members of ours are enjoying the promotions that we are running and all the merch that we're giving away and all the fee reductions that we're giving away. Once again, if you're not a part of our community, go join. It's a beautiful day to join the small community here. Members get reduced fees and so much other stuff at community.thesmallexchange.com. That's not all I got, though. I'll be right back here with Splash into Futures. A lot of stuff to trade, a lot of stuff to cover, a lot of stuff to talk about with my good friend, Peter Momet. Thanks for watching, everybody, and hang out for that. Thank you.